we had the manual papers and all, na? But apart from, like, the approach and everything, normally I had a very, and I still have a very bad handwriting, right? Honestly speaking, if I talk about myself, then my handwriting is really very bad. So, basically, why is bad? Like, that is a separate story. I'll tell you some other day. But long story cut short, I have a bad handwriting. So normally when I, like, write the complete big paragraphs, and it's really get difficult to read, right? So normally I always adopted an approach to have the short paragraphs. And my paragraph is normally is not for more than two and a half, or maximum 3 lines. And I always love to write the paper in bullet form, or in, like, the bullet way, like, like the numbers you're writing rather than the paragraphs. I always relied on the points, like, point of view. So that is again what is encouraged by the examiner as well, that you keep the paragraph short, you talk up to the point, right? There's no need to go into the depths, into the more explanation or extra or something, right? You can use the headings as well if you want to. Normally, I, to some extent, support the headings. To some extent. I mean, if you are comfortable enough with, as far as deciding about what heading should be there, it's fine. Normally, for me, I find it, I find myself being a student. If I talk about, I find myself in a difficult situation, that what to write into the heading, or what should the heading name be. To be honest with you, but because I'm talking about from the practical point of view. So if you're good at choosing what heading should you write, right? I mean, rather than, you cannot write discussion, my point of view, standards explanation, conclusion, or the conclusion heading can be there. But what about to write in the start, or the starting of standard, my perception? These are not the correct headings that you are, like, going to write, right? You can write about this, say in case if the question is asking you to contrast the difference between, I'm just giving it a typical example. If the question is asking you to contrast the difference between the non-current and the current assets, then yes, you can give a heading of a non-current asset, then you can give a heading of current asset. Similarly, if the question is asking you about the fair value model and the cost model, then yes, it's logical that you give a heading of a cost model and fair value model. It's understandable, right? And yeah, if the question is asking you about the comparison of the fair value model, or the implication of the fair value model and the impairment, and then yes, you can write fair value versus impairment. Then, I mean, this is something logical, na, where you have to do the contrast, right? But rather than writing the heading as the role of impairment in fair value model, I mean, this is not something more appealing or more eye catching or something, na? The role of impairment in revaluation reserve. This is going to be a whole line over there, na? So this is not logical. This is what basically I want to say or convey or communicate over here. So we will be talking about these as well. So we will be, like, covering up these as well, right? So you don't have to worry about how we are, you know go. We'll cover up from every aspect, so you don't have to worry about. And then these are the list of the documents that I have over here, right? And these are the accounting standards we will be covering over here. And I will be sharing this, like, file with you, uh, within the portal, Academy's portal, right? So you'll have that as well. Okay, now let's just go and talk about the reporting framework that we have over here today. Because as earlier we talked about, basically, the approach towards the SBR on the foundation, basically, the accounting foundation, basically, that we have is basically the reporting framework that we have to start, right? I just need a second and we are starting. Just 1 second only. Okay, the reporting framework, if we talk about overall speaking in this section, We are going to look at the bodies that are responsible for the development of international accounting standards, and how an entity switch over from the local gap to the international standards over here, right? So these are the whole stuff that we will be talking about over here. Now, the need for regulation, if we talk about the reasons for the regulatory framework, if we talk about, obviously, persons external to the business normally depend upon the published financial statements for information about the business. Accounting standards and other forms of regulation help to ensure adopt similar treatments for items and their financial statements are therefore comparable. And then without regulation, management would adopt whichever accounting treatment show financial statements in the best light, right? And the sources of regulation are the accounting standards, company law, stock exchange requirements. Okay, now what's this whole, the Greek language or the Russian language which I just said? I mean, it just went way above the roof. Now let's just talk about it. Whenever, remember one thing from my experience as well. Whenever you have to emphasize about something that you need, never ever try to explain that why do you need. Always try to start your explanation that what you are missing without it, what you are missing or what is happening without that thing that you need. Okay, I mean the need for regulation when we talk about now. The first point is, why do you need to have the regulation, or why do you need to have the accounting standards? Why do we need, rather than telling that why do we need, let's just talk about that. If there's no standard, then what happens? You can take the example of the traffic rules. We have a traffic rule, we have the traffic lights, zebra crossing, then we have the lines as well. Then we have the signal turn, when we are turning, we have to give the signal as well. And then similarly, we have a policy that in the school or the hospital or the busy areas, we have to drive slow. Near the school zone or near the hospitals, we are not supposed to, honk our horns or something, right? So why these rules are being created? Because without these rules, what will happen? There will be a chaos of traffic on the road. I mean, you guys must have observed over there in Mauritius as well. I don't know, but during, if at peak hours, same case, suddenly if the traffic signals stop working, what happens? Everyone tries to go first. Everyone tries to go first, right? They say just, I have to go first. Let it be for as far as the others are concerned, right? So what happens by this? There is a chaos of the traffic, right? It gets a traffic jam. Similarly, if we are not following the speed or something, normally what happens? The chances of accidents are high. If we are not following the rules and regulations of the traffic, we are endangering ourselves and the other people as well. Similarly, if we are not cautious against the near the school zone or something, then it means our kids who are there in the school, they are endangered as well, right? So these are the issues now, that without the traffic rules is going to happen. Similarly, without the regulation, everyone around is going to prepare the financial statement according to their own will, the way they see fit, the way they think that this financial information is going to give a better view of their financial statements, a better view of their company. They are straight away going to offer that. If they are not following the rules and regulations, if they are not following the accounting standards, everybody is making the accounts on his or her own. Obviously, if I am making my own, you are making your own, she's making on her own, then technically, I will not be able to understand your accounts. You will not be able to understand mine, and we both will not be able to say, we both will not be able to understand her accounts, right? So the comparison cannot be there. We cannot easily understand what is happening. And then the shareholders who are relying on the financial statements being drafted or being prepared by the directors, if they are not prepared according to some regulation or something, what will happen? how can we rely, or how can we say that the financial statements are correct, or they are prepared properly or something, right? It's a big question mark. We cannot say that they are properly prepared or not, right? So this is the issue again over here, right? So that is why we need to have a regulation. Similarly, if we want to do the business overseas, or if we want to have some transactions overseas, obviously, if everybody is making the accounts on their own, how come this is possible for us to understand that, we can do the business with some other party? Not, right? I mean, these are the issues, huh? So that is why you need to have a regulation, right? And then obviously, if you talk about as far as the constitution and the objectives of IASC Foundation, International Accounting Standard Committee, right? And then if we talk about the International Accounting Standard Board, right? So now the constitution, and if we talk about this, this is simple. The IASC Foundation is an independent, not for profit making foundation over here. And then this foundation is run by the trustees who are responsible for its financing and for the appointment of the members to the IASB. And obviously, the Standard Advisory Council and the International Financial Reporting Interpretation Committee as well, right? So this is basically a foundation being run by the trustees. And then, obviously, if we talk about as far as the International Accounting Standard Board is concerned, the board is responsible for, the developing and writing of the new accounting standards, overall speaking, right? So main objective of the ISC and the ISB, ISC is basically going to be the committee who is going to give the advisory and advices and all, and the board is the one who is going to, make up the new accounting standards. And obviously, before 2001, whatever the accounting standards they were made, they were called as the IAS. And then from 2001 onwards, whatever the account new standards or the accounting standards are coming in, now they are called as the IFRS over here, right? So this is the basic thing that you have to keep in mind, that even if it's the IAS or it's the IFRS, it's going to be backed by the IASB over here, right? And then we have the IFRS framework over here. Now, the SAC, that is the Standards Advisory Council, it provides a route for organizations to input the views and their ideas into the standard setting process, basically, right? Because it seeks input from the organization into the standard setting process. And obviously, the Standard Advisory Council, it also gives the advice to the accounting standard board on prioritizing their work and on the implication of their proposals to users and the preparers of accounts as well, right? So this is what basically we have overall speaking from the SAC point of view. Now overall speaking, this International Financial Interpretation Committee is concerned, uh they are the ones who are issuing the interpretations that provide the guidance to users on the emerging issues, right? That are not specifically covered by an accounting standard, or to provide clarity to the existing IFRSs where loopholes are identified, right? Because these are man made now. So technically, the loopholes and the margin for the improvement is over there. Like for example, the COVID-19 came and everything came to a full stop. Now during that time it was difficult for the companies to pay the interest and everything was concerned now. So we had exceptional reporting. Similarly, the world is moving gradually towards as far as the cryptocurrency is concerned, right? Still now, we don't have a proper accounting standard dealing with as far as the cryptocurrency is concerned, but still we have gotten a guidance in light of as far as the financial instrument is concerned, along with the financial the reporting framework is concerned. We are accounting for it, and sooner or later, you sooner not later, but sooner you are going to see a comprehensive standard dealing with as far as the cryptocurrency is concerned. That's going to be there, right? So basically, obviously, this IFRIC committee, it provides a guidance where the standard or the accounting standard is a bit complex or something, or where the explanation is required so as to have a proper interpretation or proper idea about what the standard is or how the things are going. So that is where you need to have this, the role of the IFRIC over there, right? And then obviously, if we talk about this framework over here, the compliance with the IFRS, if we talk about now, this IESC is not able, or has not been able to, not been able, has not been able to, plus is not in a position to force the countries to adopt the IFRS. And so it has been left to individual countries to decide what to do, and up to, what extent, to use the IFRS. Okay. This is the responsibility of the local governing body in the country to decide about either to switch towards as far as the IFRSs are concerned or not. The local governing body, for example, in Pakistan, if we talk about, that is going to be the ICAP. In UK, if we talk about, that is going to be the ICAW and the ACCA, right? So they are the local governing bodies over there, and ICAP over here in Pakistan, who basically ensures that the companies over here, the audit firms over here, they are following the international accounting standards or the international financial reporting standards over here, right? So that is the role of the local bodies to ensure that the companies or the local businesses, they have a compliance with as far as the IFRSs are concerned, right? Now, if we talk about the US over here, um, we have never seen or not heard anything about the US itself switching itself towards as far as the IFRSs are concerned, right? And similarly, if we talk about the UK itself, we have the UK gap over there. They are not into the IFRS or something, despite of the fact the ACCA is over there, ICW is over there, but still they are using the UK gap. And there is a bit of a difference between the UK and the international accounting standards that we study, right? But still, they are going parallel. But at the end of the day, even if they are following the local accounting standards, something, the reporting mechanism or the accounting mechanism is more or less same. I mean, there are differences. There are certain, points where the differences are there, but still, more or less, they are same, right? Now, if we talk about as far as the use of the IFRS across the European Union, if we talk about, for all the countries basically in the European Union, a regulation was issued requiring all the groups that are listed on the EU stock market to use the IFRS when preparing their group accounts for the financial periods beginning on or after the 1st January 2005, right? Therefore, technically speaking, the very first set of the international financial reporting standards, or the very first set of the financial statements which was in compliance with the IFRS, was being issued in the EU by, I guess, 31st December 2005 at that time, right? So it has been in place over there as well. And obviously outside the EU, right, the decision was being left to the individual member states to decide about, what is to be done and what is not to be done, overall speaking. Although if we talk about, if we go into the history and the background, the European Union was never comfortable with as far as the passing the development of the accounting standards to the International Accounting Standard Board, right? Because it was the people over there, they felt like maybe by adopting a new accounting standard, their reporting might get affected or something. So they have been always reluctant with as far as following those the international accounting standards were concerned, right? Now, overall speaking, if we talk about as far as the harmonization or the advantages of the harmonizations are concerned, obviously, there are multiple advantages as far as what the harmonization is concerned, or harmonizing the accounting treatment across the world is concerned, because it's going to be beneficial for both to those who are involved in the account preparation, and also to the investors as well, right? Because previously, if we talk about, in order to raise the finance on an overseas exchange, an entity would need to prepare the financial statements in accordance with the local standards of that exchange where the entity was looking to get the finance, right? So this was obviously time consuming, and it was also confusing for the investors as well, like because they had to look at the two different set of accounts, right, or two set of different, the financial statements, and they were kind of always unsure which one to follow and which one not to follow, right? Or which one on which they can rely on what they cannot rely. Similarly, consolidated accounts, if we talk about, they have to be prepared, or they must be prepared using the common accounting policies across all the group companies. So it meant that the adjustment must be made to the individual company accounts prior to the consolidation, which was also the time consuming and inefficient as well. I mean, if you had to go for the consolidation and if your subsidiary was not following the accounting standards, so first you had to translate the subsidiary according to the IFRSs, and then you used to go for the as far as the consolidation was concerned. So that's why it was again time consuming and inefficient as well. And similarly, for a group with entities spread across the world, right, it was always harder for the management to identify the performance problems if each entity was using different accounting policies, right? I mean, if all entities were to share the common policies, obviously it would have been facilitating, or it will be facilitating, or it will facilitates more towards the production of regular management accounts and reports as well. Because obviously, if you want to evaluate the performance of a department, obviously you have to rely on to the set of the financial statements. And if the country in which your subsidiary is, they are using their own rules, so there is a high chance and probability that maybe they are not properly written and followed over there as well, right? And obviously, if the companies who are in different countries, if they are sharing the same set of accounts means same set of rules for the accounts and all, na? So comparison between them is gonna be easier as well, right? And then obviously, to move to IFRS obviously has not been straightforward. It has not been easy for the companies as well, because if earlier, if we talk about the transitional phase, now most companies think that it's going to be an easy thing, but it's not an easy, because there are significant costs which are attached with the switching over, right? For example, the human effort or the man hours required to identify and post the transition adjustment, additional cost of account preparation, additional cost of the staff training, additional cost of the audit as well, right? Then similarly, the computer softwares or the systems that you have, you will need to upgrade them. You have to change them as well, because according to the new standard, you have to opt in. According to the IFRSs, you have to bring that thing into the software as well. So obviously, it was time consuming as well. Similarly, we have this tax rule over here now. I mean, if we talk about this tax rules over here, obviously, in many countries, even in the Pakistan as well, they have a rule-based approach towards the accounting, which is being used to determine what their tax charges are going to be, right? So obviously, the countries, if they are switching towards as far as the IFRS is, obviously they will have to rethink about their tax rules, because the tax rules were according to the old accounting standards they have, right? And now if they have the IFRS or something, so obviously those tax rules which they had earlier, they will have to be revised as well, right? Because obviously, if you do not do so, an entity will have to prepare a second set of accounts under the local gap in order to drive the tax change or tax charge, right? So this was an issue as well. So obviously, this has been the number of advantages and disadvantages that we had related to the harmonization. Now, if we talk about overall speaking this conceptual framework, the skeleton, the structure, the criteria, the base, the convention, or the regulations. Now, these regulations that govern the rules on financial reporting are a comparison of, not the comparison, rather, these no, not comparison, but rather the combination. Yeah, this should be the combination over here. That these rules, regulations, they are the combination of the national laws, accounting standards, then you have the stock market requirements and the accounting conventions, right? So all together, we are going to call them as the, like, local gap is the generally accepted accounting principles. Now, obviously, some countries have their own gaps, such as, like, the US has its own gap, so that is the US gap. Then similarly, the UK has its own gap, that is called as the UK gap, right? And then obviously, the international accounting standards are based on the accounting concept set out in the IASB framework, and all international standards are consistent with the conceptual framework as well. Just hold on for a second. I'm just taking a pause and then we are resuming. Okay, so IASB framework, if we talk about overall speaking over here, again, it has several purposes. Like, for example, these include helping the ISB when it develops their new accounting standards, helping the preparers, auditors, users of financial statements, right? Basically, the overall purpose of the framework is to encourage the businesses or the business entities to prepare their financial statements on a consistent and comparable basis, right? And this is done so because they want to have a reliable and relevant financial information for the users. Simple. I mean, if I talk about the framework, right? Now, overall speaking, if we talk about the status of the IASB framework, IASB is not an accounting standard. Okay. The framework should not be inconsistent with any international standard. But saying case, if an international accounting standard contradicts anything in the framework, then the accounting standard takes the precedence, right? The accounting standard is something that you have to follow. Now, the purpose of the framework is basically is to state the principles and the concepts that the IASB should use when developing the new accounting standards, right? I mean, what I want to say is that the framework should be able to help the national standard setters to develop their own accounting standards in a way that they are consistent with the international accounting standards as well, right? And it should help the individuals who are preparing or auditing the financial statements, like, they are helping them in the point where they, if they are unsure about how a particular item is supposed to be accounted for, right? When they don't have any particular accounting standard related to it, then you have the guidance from the framework, right? I mean, say in case if a particular accounting standard is not present to address the information or the problem, then the framework has a guidance to address it. Like, for example, the cryptocurrency. The crypto is very much like, common over there in the States and all, right? The companies are more or less interested in spending in the crypto as well. But for now, we don't have a specific standard on the crypto. But the framework, it gave us the guidance on how to record for as far as a financial instrument is concerned, but this crypto is not accounted for under the financial instruments. We are going to soon look at the accounting standard, which is solely and specifically related to the cryptocurrency. That is something which is not going to be into the financial instruments. Although it gave the idea, it gave the guidance regarding the financial instrument and all, but again, that is a separate one. So again, we had this, framework at the back, which basically guided us about how to do, right? Now, this framework as a whole, it should not be inconsistent with any international standard. But obviously, again, the same point, if the standard is contradicting or anything contradicts with the framework, then obviously the accounting standard is the one who is going to be prevailed and all, right? Now, users of financial statements. Now, if we talk about as far as the user of the financial statements are concerned, uh, financial statements in the context of the users, I mean, we can simply say that the financial statement should provide the users of the statements with the financial information about a business entity. There are many different users of the financial statements, such as shareholders, other investors, employees, lenders, suppliers, the government, the bank. I mean, you name it, and they have it, right? Even the general public at large as well. That is a stakeholder at the end of the day, right? Now, each different user has a different requirement for information, right? The IASB framework suggests that if financial statements meet the information needs of the shareholders, so they will also meet most of the information requirements of the other user groups, right? So technically, if you are following the need of the shareholders, that what do they want to have, or how they want to have the information and all that. So if you meet that requirement, technically you end up meeting the requirement of the majority of the stakeholders as well, right? Now, also, if we talk about again, as far as the financial statements are concerned, the financial statements are a way of making the management of a business entity accountable to its owners as well. Like, for example, the financial statements of a company are presented to the shareholders and inform the shareholders about the directors, about the directors, that how they have governed the company on their behalf as well, right? So that is something which is available over there as well. And then when we talk about overall speaking, as far as the objective of the financial statements is concerned, the objective of the financial statement is basically to provide the information about the financial position of an entity, its financial performance during a particular period, and the changes in the statement of equity as well, along with the changes in the cash balances in the form of the statement of cash flows. Now, the user of financial statement is going to use the information for one of the two broad purposes, basically. I mean, they can use the information to make predictions about what will happen to the entity in the future, or they may use the information to check the accuracy of their earlier predictions about the entity, such as whether the entity has been as profitable as they expected. Financial statements also are going to help the users make decisions. Like, for example, they may be used by the shareholder to decide whether to continue to hold the shares in the company or whether to sell them, right? So these are the stuff which are gonna be available to, as far as the user of the financial statement is concerned, right? Then we have the assessment of the financial position, overall speaking. The financial position of an entity is affected by multiple factors. Like, for example, the users of financial statement should not, but rather, the user of financial statement should look for the information about the nature and the quality of the assets of the entity, because obviously the entity will use these assets to generate the profits and the cash flows in the future, right? What sort of non-current assets you have, what current assets you have, what is the remaining expected life of the assets that you have, how much of the money have you invested into the non-current assets and all that. So this sort of information is basically something which the user expects to see and want to drive from as far as the financial statements are concerned. Similarly, the financial position is also affected by the amount of the debt the entity owes and whether it will be able to afford to repay the debt or not. And similarly, the user of the financial statements will therefore look at the mixture of the debt and equity capital in the entity's structure as well, right? Similarly, another aspect of the financial position is the liquidity that we have, or the access to the cash to meet the short term obligations to pay the employees, right? And similarly, they have, when they are looking to pay as far as the employees is concerned, they have to see that whether they can pay to the suppliers, whether they can pay to the other debts or not, right? Similarly, the liquidity, it can be assessed by looking at the liquid assets and the short-term liabilities of the entity as well, right? So this information on the financial position is provided uh, like you know in the statement of financial position to assess, obviously, and the disclosure notes as well. So this information is basically being extracted from there as well. And then if we talk about the financial performance over here, obviously the performance is basically what we have earned and what we have lost. Earned means the profit, loss means loss means the loss, the expenses that we have. And obviously, the financial performance of an entity is going to be measured by the profit and loss in the in the given period of time, the amount that you have earned or the amount that you have lost, and obviously the information regarding the revenue, the cost, the profit. It's all there in the income statement, right? It's everything is over there, right? And then obviously, the user of a financial statement. I mean, if I'm the user of a financial statement, obviously I am going to evaluate the financial performance in the way I am going to see that what annual profit am I going to get the next year or over the number of years. And obviously I am going to have an estimation of what amount of profits can I expect to have from the company in the future. And then again, on the basis of that, I can think about and I can decide about whether I want to hold the investment over here in the company or not, right? So these are the stuff that I can think of, right? Okay, now let's just have a break of 4 5 minutes or so, and we are going to come back after the break, and then we are going to resume. Okay, so time to get up from our seats. Let's just walk around a bit, and then we'll come back, and then we'll resume. Let's have. Okay, I'm back. So let's resume now. And here we go. Okay, so we were talking about the financial performance over here. We were done with this, and now moving ahead, we have two basic accounting assumptions. Although we have four assumptions. And apart from the accruals going concern, we have the matching as well. And then we have the prudence as well. But overall speaking, as far as our accounts are concerned, these are the two vital assumptions that we have. Now, obviously, the accounting standard board, if we talk about and the overall framework, it states that the conceptual framework, uh, the preparation of the financial statements is based upon two assumptions, right? And these assumptions are the accrual and the going concern. Accrual basically is also somewhat related to the matching as well. And when reporting the profit or the loss in the period, sales must be matched with the cost of sales and the expenses that relate to the time, such as the salaries, rental cost, and the depreciation, it should be charged in the time period to which it relates, regardless of actual cash payment, right? That we have done. Similarly, the revenue and income might therefore be recognized in the different financial period from the period in which the cash income is received or the cash payments are made, right? Like, for example, we can simply say that the cost of non current assets that we have, right? Now, these are spread over to multiple years according to the rules of the accruals, basically the depreciation that we charge into the accounts. That is the best example of the accrual concept. Basically, we have incurred the cost, but the cost is charged, the cost of the non-current asset is charged to the income statement in chunks over the number of years, right? Over the number of years over which the benefit we have from the asset is expected to be derived upon and all, right? Similarly, the going concern concept is the one where we say that for the foreseeable future, the entity will continue with its operation and all, right? And the entity will be able to pay all its liabilities when they are due for payment. So, as a result, it will not be in danger of insolvency or the liquidation, right? So it will continue to trade and will be a going concern, right? Then the use of this going concern assumption basically affects the methods used to value the assets, right? Now, if the entity is not a going concern, assets will have to be valued differently at their breakup value, at their realization value, right? This is realization value is the value that is going to be their sales value in the event that the entity is liquidated and its assets being sold off, right? And then if we talk about as far as the qualities of the financial information, the ISP framework identify the four qualities that are required for the financial information, and that is the understandability, reliability, relevance, and comparability. And obviously, consistency in principles and methods of preparation has to be there as well. Now, overall speaking, obviously, the financial information has to be or it must be understandable for the users to whom the information is being presented, and obviously the users who have a bit of a knowledge regarding the business and the accounting, they should be able to understand that what the information has been presented to them. Similarly, the information has to be reliable. The users should be able to trust it, and they can, they should be in a position to rely on it for making their economic decisions and all. Similarly, the financial information, it must be relevant as well, and this means that the users should be able to use the information to make the decisions, and the information should be relevant to the decision and is going to help the users to make up their mind, and it helps them to make up their decision as well. And then obviously the financial information, it has to be comparable as well, because the user should be able to compare the information in an entity's financial statements with the similar information in the financial statements of the previous year, or with the financial statements of another entities, right? So the information, it has to be comparable as well. Now, the important aspect of the comparability is basically the consistency, right? Consistency is the key over here. Why? Because the principles and the methods that are used to prepare the financial statements, they should be applied consistently by all business entities and from one year to the next, right? So this is really very important over here as far as the reliability factor is concerned. Now, if we again talk about in the context of the reliability factor now, the information that we get, obviously it has to be reliable information needs the following: fair representation, substance over form, neutrality, prudence, then the completeness as well. Okay. If we start one by one, obviously as far as the fair presentation is concerned, obviously the information has to be presented in a faithful manner. In a faithful manner, I mean, what or fair, that is basically the information, the transactions or the information that we have, what we are reporting in the accounts, it has to be reported at its proper value, proper cost, and the assets and liabilities should be shown in the statement of financial position in a way that they fairly represent their true value or amount, right? This is how we can get it right. The fair presentation, I mean, you are fair enough as far as related to your operations and your transactions, that you are accurately and you are truly showing that what the cost is or what the amount is or what how the whole information is, right? Similarly, the financial statements, they should represent the economic substance of the transactions of an entity, And in cases where the economic substance is different from the actual legal nature of the transaction, the economic substance should be reported rather than its legal form, right? So, substance over form is the transaction is reported at its substance rather than the legal form, the actual definition, if we talk about as far as the substance over form is concerned. So, basically, we don't go for the legality or the legal title, we see that what is the substance of the transaction. For example, the leases, when we get the asset on the lease, although the legal title is not with us, but if the terms of the lease are satisfied, we are tend to and we are required to report the asset or the leased asset as our own. And similarly, we have to record the corresponding liabilities for the lease as well, right? And then obviously, when we talk about the neutrality, now that is the freedom from the biasness. We can simply say that the financial information, it should be free from bias or neutral. It should be free from biasness and it should be neutral, right? I mean, obviously, when the estimates are included in the financial statements, uh, obviously the estimations, they come with some uncertainty or all, but obviously, the caution has to be or should be used while making the judgments and all, right? Because prudence itself means making sure that when there is uncertainty about the value of an asset or something, the entity should not overvalue the asset in the financial statement. Similarly, obviously, when there is an uncertainty about the liability or the future payment, the liability should not be understated, right? It's just like the prudence concept that we have, that the asset should not be overstated, and the liability should not be understated, right? And obviously, the prudence is something which involves the use of sensible but cautious judgment when making the estimates are concerned, right? And then the financial information, it should be complete, which means that it should not omit anything that is material, and the omission of the information that is not material, but it does not affect the usefulness of the information, that's something which is permitted, right? So you're skipping something which is not going to affect the decision of the users of the financial statements or something, that is something which is allowed, that is something, yes, you can do, right? But the information which you think that might affect the decisions of the or might affect the the shareholders or something, that is something you need to disclose and all, right? Then we have the relevance of financial information. Information is relevant when it is used to make decisions. Information is used to make estimates about the future, obviously if it has a predictive value, or to check the accuracy of the previous estimates, it has a confirmatory value. And obviously, the information is not relevant if it's not material. Obviously, if the information is not material, if it's not going to affect you or something, obviously, then that sort of an information is something which we say it's not relevant to us, right? And similarly, the information is not going to be relevant if it's too late for use as well. See, so the timeliness characteristic of the financial information is coming in over here, that if you are getting the information but you are getting the information late, then there's no point of getting that information. Okay. So long story cut short, if you want to have an information, you have to make sure that you get it on a timely fashion and all, right? So this is important as well. And obviously, the ISB framework is also states that the information is relevant if it has a predictive value or a confirmatory value as well. I mean, if we talk about these two from points over here, right? And then obviously, it is going to have a predictive value if it can be used to make the predictions about the future. And the confirmatory value is going to be when you can use it to check whether the previous estimates were correct or not, right? So this is what we have overall regarding the relevance of the financial information. And remember, this point is really very important as well. That no matter how confirmatory or the predictive value it is, if it's not communicated to you in a timely fashion, then there's no use of it. Then you cannot have a proper use of it or something like that as the relevant information. It must be timely. It has to be timely as well. This means that it must be provided in time to make the decisions for which it is needed, right? And if information is provided too late, it has no relevance to any purpose, and so has no value over here, right? And then if you talk about from the relevance and reliability point of view, we can simply say that you know there are certain occasions when the financial information cannot be as relevant as it could be, and at the same time as reliable as it could be. I mean, obviously, these are the situations where you have to compromise between the reliability and the relevance as well. I mean, for example, there might not be enough time to gather the complete information, and it may therefore be necessary to provide the information that is incomplete but not too late. Getting my point? That at times you need to have a quick information so that you can take up a decision or something. Like, for example, um, you are getting an information regarding some company who's um, who has a litigation in the court, and there are the chances. I mean, as soon as the case is going into the court, as the things are getting unfold and all, nah? So there comes a point that the company is going to have a financial loss. But how much of the financial loss, this is something not clear to you at the moment. But obviously, as soon as you get the information that the company is going to have a financial loss, obviously its share price is going to have a negative impact. So now, in order to mitigate your overall impact and all, na, so you take a timely decision. Although how much of the loss can be there, or how much the financial penalty can be there on the company, it's not clear. But still, you want to avoid it, so that is why you are ready to take up a decision, right? So the cost of providing the information may also affect the reliability and the relevance as well, right? Because information with additional relevance and the reliability should not be provided if the cost to the added of the added information, or the added information that you get regarding the relevance or the reliability is going to exceed the benefits, which are going to be obtained from it. Now, so obviously you shouldn't be going for the add-on extra efforts or the money that is being involved for that, right? Similarly, if we talk about the recognition in the financial statements, assets, the liability, income, expense, they should be recognized when they meet the definition of an element, and when they satisfy the certain criteria for the recognition as well. I mean, we have talked about the assets, that when it is probable that economic benefit will flow towards the organization, and that economic benefit can be controlled as well, or the controlled economic benefit, that's an asset. Similarly, the expiration of economic benefit is an expense, and when that same economic benefit is earned, that is the income. And then when we have to have an outflow of that economic benefit to settle something from the past, right, or the obligation from the past, that is the liability. Similarly, when that economic benefit is invested, that is called as capital, right? And obviously, when we talk about the recognition criteria, we all know that we have multiple criteria so as for the recognition of the asset, expense, income, liability, and capital are concerned, right? Similarly, when we talk about the five elements, again, the asset, liability, and everything that we have already talked about the asset over here, controlled economic benefit as a result of the past event from which the entity is expected to obtain the future economic benefits. That is what the asset is basically, right? And then again, recognition in the financial statements, we have the recognition of the income and expenses, which follows the balance sheet approach. Income is recognized when an increase in the future economic benefit arises from an increase in asset or reduction in the liability. And similarly, the expenses are recognized when a decrease in future economic benefit arises from a decrease in asset or an increase in liability. Basically, this balance sheet approach is something by which we do the double entry. Like, for example, if you remember, when we have paid off an expense, we debit the expense, and obviously, when we have paid it off, there is a reduction in the cash as well. No? So, cash is the asset. So the increase in expense via the reduction in asset, or when we receive a bill, we debit the bill in the expense and then we credit the bill payable, or we record the expense and we increase the liability. So the expense is recorded in two ways. One, when there is a reduction in asset, or when there is a increase in liability, right? So this is what it is saying over here. Similarly, for as far as the income is concerned, if we talk about the income over here, it's same rule for the income as well. And for income, we are saying over here the income is going to be recorded when it is going to increase the asset, right? Cash, debit, income, credit, or when it is going to increase some asset, or increase some asset in the context of obviously the cash or the receivable, or reduction in liability, because the reduction in liability is also recorded as your income as well, because at first you had a tentative outflow which you are now avoiding. So that is what you are going to have over there. And then we have the measurement of the elements of financial statements. Obviously, we have the measurement at the historical cost or the current values, realizable value, and the present value. So basically speaking, we have these measurement criteria, that these are the several measurement bases that are used for the valuation of the elements of the financial statements that we have, right? Historical cost is something that is used for the non-current assets or the tangible non-current assets. Current cost or the current value is something that normally we are using for the financial instruments as well. Similarly, the realizable value is used for the inventory. Present value is basically used for the liabilities as well, right? And then obviously, as far as the selection of the accounting policies and all is concerned, the policies are what we are adopting the specific principles, basis, convention, the rules which are applied by an entity in preparing and presenting the financial statements. And obviously, when selecting the accounting policies, management has to refer to the requirement of the accounting standards or the guidance from the interpretation. And then obviously the definition, recognition criteria, measurement concept from the ISB frameworks are there, right? Which are guiding us to account for as far as the accounting policies and everything is concerned, right? And then obviously we have read about the IS 8, that is the accounting policy estimates and change in accounting policy and estimates now. So obviously the change in accounting policy is only allowed if the change in policy is required by some law or by some accounting standard, or the change in policy will result in reliable and more relevant information. That is where the change comes in. Basically the change is somewhat because of the accounting standard. And we have this retrospective from now backwards. We go back and we change it up from the day one that we were applying the policy and all, right? So this is how basically we go with that. And then obviously, consistency of presentation is something that is needed for information to be comparable. Therefore, IS-1 requires consistency in presentation and classification from one year to the next. And obviously, when there is a change in operation or review of financial statements, which indicate that a different treatment would be more appropriate, or a new accounting standard requires a change in the treatment. So that is what basically we have over there. And then obviously the materiality and aggregation, that each material class of similar item should be presented separately in the financial statements. That is the if you have a particular event, it should be presented over there. And then obviously the items of dissimilar nature should not be aggregated unless immaterial, right? And then obviously offsetting of assets and liabilities, income or expenses, is not allowed unless the it's required by some accounting standard or interpretation, or it reflects the economic substance of the transaction. Then in that case, yes, you can do the contra basically over there, or you can net them off, right? So this is what we have. And then obviously we have this fair presentation over here with us as well. And that is under IS-1. Financial statements are required to present fairly the financial position, financial performance, and the cash flow of the entity. And the fair presentation is achieved where the IFRSs are complied with, The information has the characteristics of the relevance, reliability, understandability, and consistency, and the economic substance of the transaction has been accounted for. So basically, again, long story cut short, if we talk about the fair presentation, it is only achieved if we have properly followed the accounting standards. If we have, we can say that we have fairly presented overall as far as the information is concerned, right? So, this is what we have overall speaking for this conceptual framework. I am going to stop over here for now because I don't want to rush straight away, from the day one, because I just gave you this idea about the conceptual framework because in most of the questions, when we are going to talk about from the accounting standard point of view, we will be discussing something like, what is over there, even in the, the conceptual framework as well. So the reason being for, discussing about the framework is that you get something, the basics, that what is happening around or what the accounting is basically based upon, right? The reason for the discussion is this, right? And what you have to do is I will be sharing these slides over there onto the portal. So you can go through these, you can read these as well. And then obviously I will be sharing the latest book and the kit as well. So you can start doing the chapter number one over there, which is related to the framework and all, right? So I'm going to pause over here for the day. I don't want to start with the newer one because I have to start the asset family next. And obviously I have the plan of this, we'll start the asset family from the next class, and we will be covering up from all the assets as for for example the IS 16, 20, 23, 40, even 36 as well, and the rest of the other standards as well. So we'll start from the next class, okay? Meanwhile, if you guys have any question or something, you can ask me. Otherwise, we are almost done for the day. Any question, anyone? No question? I hope you guys are up and not sleeping. Huh? Okay, done. So, I guess we'll start the asset family from the next class. Okay, okay, okay. And we have this one more student. I didn't ask about you. MJ, Miss MJ. Uh, I guess Domina, yeah. Would you like to please unmute yourself and tell me that what paper you are studying this time and what papers you have passed? MJ, can you hear me? Okay, maybe there is. Okay, it's your first paper in level three. Okay, and you have cleared your when you cleared your F7. I mean, what was the last time when you cleared your F7? Okay, so you had a break of the whole year. Okay, no problem, no problem. It's perfectly fine. It's perfectly fine. I'm just taking guys from the basics, so we will be able to cover up, right? Next class is really very important because we will be comprehensively covering up the asset class, right? And we'll be covering from the basics as well. So we'll be discussing about each and everything, okay? So time to say bye. I'm going to see you next week, same time, same place, same channel. So till then, take care of yourself, your family, your friends, and the people around you. And next week, a new topic, a new day, and a new start. Till then, take care. Bye bye.